Hello, hello. Yes, good afternoon, everybody. I hope you can hear my voice and at the same time see my screen clearly. So today's webinar, we're going to look at certain chart patterns. You can call them models. We're going to look at certain chart patterns that are very, very profitable. There's some patterns which I've traded them for some times. I've looked at them for some times and I found that they are very, very profitable, especially if you look at them carefully. So what I'd like us to do is most people, if you just draw the patterns on your own, that is, you sit down and you just draw them on your screen, you just pick lines here, unless you're very, very professional, you'll find that you're being very, very judgmental. That is, judgmental means you'll say you expect the price to go like this, even though that's not exactly what's going to happen on the chart. Like if you have a buy position and you're trying to draw those zones, you'll find yourself drawing them in a way that they indicate upwards. So that's why I'm using this indicator. The indicator I have on my screen, it's not for decoration. It is there because I use it specifically just to find the patterns, when to trade the patterns, and when I'm having a very good pattern. So there are very, very, very many patterns. There are very, 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 very many patterns, but we won't be looking at all of them. We just want to look at some few ones that are very good. The first one, the first pattern which I want us to look at, the first pattern which I want us to have a look at, the first one is the expanding wedge formation. So from the name, expanding means it gets wider as we move into the future. That's the first one. The next one is contracting wedge formation. So if you've been trading for some time, you'll be able to know that these are actually the main patterns that are there, except apart from the rectangle formation. These are always the main ones. They're the ones that are now translated to be triangular formation, hedge, and all the other names you can give them. But if you look keenly, they are either expanding wedge formation, or they're contracting wedge formation, or the rectangular formation. Those are the three main ones, which are now translated into the other parts that you can call triangular formation, hedge formation, or whichever name you can call, ascending triangle, descending triangles. They're just one and the same thing. So I'm trying to make reference to some other tool. Yes, they're just the same. Hedge, we have the engulfing formation, and then we have two types of bullish engulfing formation. That's the bullish engulfing formation and the bearish engulfing formation pattern. Sorry. And then there is another pattern which is known as the head and shoulder patterns. We are not going to look at that at the moment. And then there is the double top pattern, and we also have the double bottom pattern. And then there is the cup and handle pattern. Then we have the bottom line. So all those they can be categorized as patterns that show that the price is reversing, or patterns that show that the price is continuing in that direction. They are just of those two types. The ones which show that the price is continuing in this given direction, and the ones which show that the price is reversing from that given direction. So I want us to start off with contracting wedge formations. Contracting comes from the words decrease. Contract is to decrease, like to reduce in size as the price progresses into the future. So assuming we have these two lines and the price enters from the left, then the price goes up and then it reverses. We have again the price goes up and then the price goes down. You can see that as the price progresses into the future, the width decreases, the width of the triangle decreases. You can see it keeps decreasing as the price progresses into the future. So we have this, we have this, we have this, and we have this point, we have this point, we have this point. So these are like the coordinates of this shape. If you want to trade inside this shape here, ensure you be selling when the price touches these levels there. Like you'll find yourself picking a sell. Yeah. You'll pick a second sell here. And you'll pick a buy here. Pick another buy here. And then you'll pick another buy here. So you can see that as the price is progressing into the future, we are finding scenarios where these are good places to buy from. The lower trend, this is a good place to buy from. In the upper trend, these are a good place to look for a buy from, a sell from. So if you pick a buy along any of these lines, you're supposed to be looking for a buy, a sell here. In case the price ascends and closes above this trend line, we want to see a retracement back towards the same line which has just been broken to pick a buy position. So expect a retracement back to the same level to pick a buy position. And when you buy it here, if you successfully pick a buy there, your first target, the most guaranteed target usually is when the price hits this high here. This is always the most guaranteed place that when the price gets to it, it's actually going to, it's likely going to hit this level. If that line is broken, the next target is usually at the anchor points where the price touches this level here. So this is the best place to look for a buy from. So this is an example of a contracting wedge formation. We want to also look at an expanding wedge formation. Let's see. So expanding comes from the word expand, where as the price progresses into the future, it gets wider. The range between the two trend lines gets wider. So we'll have this here, and then the price goes down, and then the price continues up, and then the price goes down, and then the price continues up, then it goes down, and then it continues up until eventually it either breaks above the upper line or it breaks below the lower line. So when this happens, when the price breaks above this upper line, usually we wait for a retracement towards the same level for us to pick a buy position. And in case the price breaks below the lower line, we normally wait for price to retrace back towards the same trend line to pick a sell position. So you either wait for a break above and a retracement to pick a buy, or a break below and a retracement to pick a sell position. Your take profit is 2 times the value of the range. That is, if you pick a sell here and the range is between this point and this point, your take profit is always half of this or the same size as this length here. So basically, those are the two, they're the two main patterns. Every other patterns like is derived from these two. You may think that I'm just saying for this, but from experience, all the other patterns, that's the ascending triangle, descending triangle, hedge formation, whatever name you can choose to call them, all of them come from these two. The only thing which does not come from these two is the engulfing chart pattern. The other thing is the how do you call it? Is the, I don't know, you can call it crow pattern or the 3 green candles pattern. or the three red candles pattern. You can give them that name. I want us to look at this real chart and see where we have such a pattern. The two patterns which I've just drawn now. So you can see right now on this chart we are having this trend line. So I'm using this indicator not because it's the only indicator which you can use for this, but because usually if you draw them yourself, that is, you just sit down and draw them, you will find that you are very, very judgmental. You may not know exactly where the lines are. So this indicator is just to help new traders to know exactly where to draw the lines, because when you draw them like this, they are not judgmental. They're drawn based on strictly what's happening in the market. You're not trying to guess. You can see here we have a very good trend line. We have another very good trend line. So you can pick a sell from this lower line, this line here, or you can pick a buy from this lower line. If the price breaks above any of these lines, the upper line, that means the price is continuing upwards. If the price breaks below the lower line, that means the price is continuing to the lower side. So you may look for a buy after the break above this trend line, or you may look for a sell after the break below this trend line here. So you either buy here or you wait and sell a break below this trend line. So you can see that there are very few there are very few such patterns on higher time frames. Usually the best place to look at them is lesser time frame, like the 5 minutes time frame or the 15 minutes time frame. There are going to be very, very many there. So look at this. We have that. You can see this is another very good converging wedge formation, and the indicator has drawn it perfectly well. This indicator is the normal zigzag indicator. There's nothing special to it. It's just the normal one with the default settings. You can see that it gave a very good indication, and through the price broke and then continued in that direction. This is you may not look at it as converging wedge formation, but it is a converging wedge formation. You can see it is a very good converging wedge formation, and after this breakout the price went up to our take profit. Then we have another. So focus at your free time. Don't just sit down and then start looking at your charts. When you're looking at a chart, ensure that you find something to do. That is, keep drawing these lines as many times as possible. Find these ranges. The more you draw, the more you tend to understand, and the more you'll end up knowing. If you draw a lot of them, if you can draw like 10 of these shape patterns within one day, you'll find that after a month you'll be very, very good. You'll be able to see them when they're happening. So you also have another one here. Just look at how many they are and how many they are successful. So we have a very good shape, a converging wedge formation here. There is a break below. This is a continuation to the lower side. And then now we have an expanding wedge formation. This is a very good example. So somebody may be wondering how comes I was focusing so much on contracting wedge formation, but we also do have expanding wedge formations. So we have an expanding wedge formation. You can see it was expanding into the future before eventually price broke below it. And if you took double the take profit, where the stop loss is and the take profit, could still have got it right. And then there is a contracting wedge formation. So this is a case where there is the contracting wedge, sorry, it actually hit the take profit. So this was a good one. We have a contracting wedge formation. There is this one, this is a sell. So if you took a sell there, you can see that the price actually hit this anchor, this one. It actually went up to it, and that's why we take the take profit. So you can see from these examples, the ones we've just looked at now, that it is true that whenever the shape happens, the price tends to respect it perfectly. So I want us to look at engulfing candles and when to use the engulfing, because we did a webinar sometimes back where we talked about engulfing candles, and it looks like some of us misunderstood it. Some of us misunderstood what we looked at. So let me tell you something. Whenever you're trading engulfing candles, you're not just entering the trade because the engulfing candle has shown up. No. The most important thing is to look at the direction of the market. Is the market going up or is the market going downwards? If the market is bearish, then it is safe to look for engulfing candles that are pointing in that direction. That is, you look for engulfing candles that are pointing downwards to look for sell positions. And if you have engulfing candles that are pointing upwards in a downtrend, you look for sell positions. Like for example, you can see there are several. We do have several red engulfing candles here. These are red. They mean that the price is going downwards. Before you pick a sell blindly based on this engulfing candle, look at it. Before you pick a sell based on that engulfing candle or whichever engulfing candle, just ensure that the highs here are actually getting lower. So highs getting lower means that the price is going downwards. Like when you have this is a highest high, this is a lower high, this is another lower high, and this is a lower high, which means that within this highs getting lower scenario, these ones, we will be focusing only on bearish engulfing candles. And when we see a high which is higher than the previous high, and then a bullish engulfing candle happens like we are seeing here, we pick a buy position. Is that clear? So that would mean that we could not have taken this sell position. We could have taken this sell, but not this sell here. But we could have taken this buy. Is that clear? Does that make sense? Does it make any sense, whatever I'm saying? Ignore this indicator. Ignore this indicator, the one. So ignore this break of structures indicator. I'm not looking at it at the moment. Like we've done a similar webinar before. We looked at this some certain chart patterns, the ones we've not looked at today. But that's what I wanted us to look at today. So thank you very much. That should be the end of today's analysis. We're going to meet again tomorrow at the same time. On Wednesday at the same time. Thank you and see you.